Okay, so you want to own a SaaS company. Here's the thing that surprises people first. You're not really building an app. You're building a subscription relationship with a group of strangers who have to keep believing, every single month, that what you charge them is worth more than what they'd lose by walking away. Miss that bar even slightly, and the business quietly bleeds out one quiet cancellation at a time, no matter how clever the code underneath it is. Software isn't the hard part of this business. Staying worth paying for, forever is. Let's start with how you'd actually start this, because most people get this part backwards before they ever write a line of code. You do not start a SaaS company by building a product first. You start by finding one specific, painful, recurring problem that you personally understand better than almost anyone, ideally one you've lived with yourself in a job or a business you already know from the inside. The founders who actually make it almost never start with, "I want to build software." They start with, "I am furious that this one task eats 4 hours of my week, and there is no decent tool for it." The software comes second. The specific, personal frustration comes first. Once you have that problem, the real first move isn't a code base. It's what's usually called a concierge MVP. You solve the problem manually, by hand, for 5 or 10 people who actually have it, often using nothing more than a spreadsheet, a shared document, and your own labor standing in for the software you haven't built yet. You charge them for it from day one, even if it's a small amount, because a stranger's willingness to actually pay is the only signal that matters at this stage, and it's a signal no amount of friends and family enthusiasm can substitute for. Only once several people are paying you to solve this by hand do you start building the thinnest possible piece of software that replaces your own manual work, usually stitched together from off-the-shelf tools, a payment processor like Stripe to handle billing, and as little custom infrastructure as you can get away with. The distribution side of that first move matters just as much as the product side. Most solo SaaS founders don't have a marketing budget, so the earliest customers almost always come from somewhere the founder already has credibility, a community they're already active in, an online forum full of people with exactly this problem, a small following built by publicly documenting the process of building the thing, or simply cold messages to people the founder knows have this exact pain point. A launch on a platform built for exactly this, where early adopter audiences actively look for new tools, can bring in the first few hundred signups in a single day, but it's a spike, not a strategy, and the founders who last treat it as one data point among many rather than the whole plan. A useful way to picture those first few months concretely. Week 1 is spent finding 10 to 20 people who have this exact problem and talking to them, not pitching them, just understanding exactly how they currently deal with it and what they'd pay to never deal with it again. The following weeks are spent solving it for the handful who agree to pay, manually, badly, by hand, while watching closely for the moment the manual process becomes the actual bottleneck rather than a fine stopgap. Only at that point does writing software become the right next move, and even then, the first version is deliberately narrow. One core workflow, done well, rather than 10 features done adequately. Founders who skip straight to building a polished, feature-complete product before that manual phase almost always end up polishing something nobody was waiting for. The financial bar to start this way is lower than almost any other business in this series. You don't need a factory, a warehouse, or a fleet of anything. Most solo founders start for the cost of a laptop they already own, a few $100s a month in software and hosting tools, and their own unpaid time, which is the real currency being spent here. What it actually costs is months, sometimes years, of being paid very little while you find the version of the product people will renew for. The most common early mistake isn't a technical one. It's building for 6 months in isolation before a single stranger has paid a cent, guessing at features instead of asking, and picking a market so broad, productivity software for everyone, that no specific person feels like it was built for them. The founders who make it pick something almost embarrassingly narrow at first. Invoicing software for one specific type of freelancer, scheduling software for one specific type of clinic, and only widen out once that narrow version is already working and renewing. Now let's get into how the money actually works once the thing exists, because this is where SaaS becomes a genuinely different animal from most other businesses. You are selling access, not a product, which means your customer has to affirmatively decide to keep paying you, typically once a month, forever, or the relationship ends automatically. That single structural fact is why SaaS companies obsess over a small set of numbers that barely matter in other industries. Monthly recurring revenue, or MRR, is the current run rate of subscription income, and it's the number that actually describes the health of the business, far more than any single month's cash in the bank. Churn is the percentage of customers or revenue that cancels each month, and it is the quiet killer of this entire business model. A company can look like it's growing beautifully on a chart of new signups while actually shrinking underneath, because enough existing customers are leaving out the back door to cancel out everything new coming in the front. A 5% monthly churn rate sounds small until you realize it means losing almost half your customer base every year if growth ever stalls. Against that churn, you have to weigh two other numbers: customer acquisition cost, what it costs in marketing and sales to land one paying customer, and lifetime value, roughly how much revenue that customer generates before they eventually leave. The commonly cited healthy ratio is that lifetime value should be at least 3 times acquisition cost, and that the company should earn back its acquisition cost within about 12 months. Because if it takes longer than that, growth itself starts to require more and more cash just to stand still. This is the trap that swallows more SaaS startups than any competitor ever does, spending aggressively on ads and sales reps to grow the top line, while churn and long payback periods quietly make each new customer worth less than what it costs to acquire them. The reason this business model can work at all, despite those brutal customer acquisition dynamics, is gross margin. A typical SaaS company keeps somewhere between 70 and 85% of every dollar of revenue after covering the direct cost of serving a customer, mostly cloud hosting and basic support, because software, once built, costs almost nothing extra to hand to one more customer. Compare that to a restaurant or a mining operation, where each additional unit of output costs almost as much as the last one. That's the appeal that draws founders and investors into this business in the first place. The marginal customer is nearly free to serve, so growth, if you can get it efficiently, converts into profit far faster than in almost any physical business. Pricing itself usually follows a tiered structure. A free or heavily limited entry tier designed purely to get people using the product and talking about it, a mid-tier aimed at individuals or small teams, and a custom enterprise tier sold through direct sales conversations rather than a self-serve checkout page, often at 10 or 20 times the price of the mid-tier for the same core product plus better support, security guarantees, and account management. Some companies charge per seat, a flat fee for every person on the account, which is simple to understand but caps revenue to headcount. Others charge based on usage, more emails sent, more data processed, more API calls made, which scales revenue directly with how much value a customer is actually extracting, but makes monthly billing less predictable for the customer and for the company forecasting it. Growth generally comes from one of two playbooks. Product-led growth lets the software sell itself through free trials and word of mouth, keeping the cost of acquiring a customer very low, but usually caps out at a lower average deal size. Sales-led growth puts a human salesperson between the product and a big-check enterprise customer, landing much larger contracts, but at a dramatically higher acquisition cost per customer that only pencils out at scale. Most successful SaaS companies start on the free, self-serve end of that spectrum and layer sales-led enterprise deals on top only once the core product has proven itself. There's also a number investors watch even more closely than raw growth: net revenue retention, which tracks whether your existing customer base, on its own, with no new customers added at all, grows or shrinks over a year. If existing customers upgrade to higher tiers and add more seats faster than others cancel, net revenue retention rises above 100%, meaning the business would keep growing even if new customer acquisition stopped entirely tomorrow. Investors also use a rough shorthand called the Rule of 40. Add your annual growth rate to your profit margin, and if that combined number clears 40, the company is generally considered healthy, whether it gets there by growing fast while losing money or growing more slowly while highly profitable. There's a cost most outsiders never think about, too. Keeping a customer paying is its own ongoing expense, not a one-time sale you can forget about. Beyond a certain size, SaaS companies build out customer success teams whose entire job is making sure paying accounts actually adopt the product deeply enough that canceling would hurt, proactively reaching out before renewal, and spotting the early warning signs, falling usage, a champion inside the account leaving their job, that predict a cancellation months before it happens. That function is also where expansion revenue comes from: an existing customer adding more seats, moving up a tier, or turning on a paid add-on, all without any new customer acquisition cost at all, which is exactly the fuel behind the net revenue retention number investors care so much about. Let's ground all of this in a real company, because the abstractions only mean something once you see them play out. Mailchimp started in 2001 as a side project inside a web design agency, called Rocket Science Group, run by two Atlanta-based founders, Ben Chestnut and Dan Curzius, who built it to solve their own agency's email marketing headaches for clients. For years, it stayed a side income stream while the agency work paid the bills, exactly the kind of narrow, personally felt problem the earlier part of this video described. The turning point came in 2009, when Mailchimp launched a genuinely free tier for small mailing lists, a classic freemium move that turned the product into something small businesses, bloggers, and solo entrepreneurs discovered and recommended to each other without any sales team involved at all. From that point on, Mailchimp scaled almost entirely on word of mouth and self-serve upgrades from free users into paying tiers, the product-led growth playbook in its purest form. What makes Mailchimp remarkable as a case study isn't just the scale it reached. It's the fact that Chestnut and Curzius never raised $1 of outside venture capital across the company's entire independent existence. Every bit of that growth was funded by the company's own subscription revenue, reinvested back into the product, which meant the founders answered to paying customers renewing every month and nothing else, not to a board demanding growth at any cost. That discipline showed up directly in the numbers. By the mid-2010s, Mailchimp employed several hundred people and was reportedly generating hundreds of millions of dollars a year in revenue, entirely self-funded, at a time when venture-backed competitors were burning far more cash to grow more slowly. By the time Intuit acquired Mailchimp in 2021, the company was reportedly serving well over 10 million customers worldwide, and Intuit paid roughly $12 billion for it, making it one of the largest acquisitions of a fully bootstrapped company in the history of the software industry. Both founders reportedly became billionaires from a company that started as an unfunded side project, solving one specific, narrow problem for their own design clients. Now, the honest downside case, because this business model destroys far more attempts than it makes rich. The graveyard of abandoned SaaS side projects is enormous, and almost never because the code didn't work. It's because the founder built for months in isolation without a single paying customer to validate against, or picked a market too crowded and undifferentiated to stand out in, or priced so low, out of fear of asking for money, that there was never enough margin to fund the marketing needed to grow. Venture capital, when it does come in, can actually make this worse before it makes it better, because a large funding round can paper over genuinely bad unit economics for a year or two, letting a company spend far more acquiring customers than those customers are worth, right up until the money runs out, and the underlying churn problem is suddenly impossible to ignore. Mailchimp's own rise looks even sharper set against that pattern, precisely because it never had outside money to hide behind. It's worth noting that plenty of well-funded competitors existed in Mailchimp's own space, most notably Constant Contact, which took the opposite path, going public in 2007 and competing with far more capital behind it, before eventually being sold off itself. Having more money never automatically beats having lower customer acquisition costs and a product people actually love enough to keep paying for. Concentration risk is real too. A SaaS company that depends on one or two large enterprise customers for a big share of revenue can look stable for years, until one contract doesn't renew and takes a double-digit percentage of the whole business with it in a single quarter. And competition risk in this industry is unusually direct, because a well-funded rival can often copy a successful feature within months, meaning the actual defensible advantage in SaaS is rarely the software itself. It's the accumulated trust, workflow lock-in, and switching cost a company builds up with customers over years of reliable service. What actually separates the SaaS companies that make it from the far larger number that quietly shut down usually comes down to the same handful of things. They found their first paying customers before writing much code, not after. They picked a specific, narrow, deeply felt problem instead of trying to serve everyone. They watched churn and retention as closely as they watched new signups, because a leaky bucket doesn't get fixed by pouring in more water at the top. And they let profitable, patient, customer-funded growth set the pace, the way Mailchimp did for 2 full decades, rather than mistaking a big funding round for proof that the business actually works. So if you're serious about owning a SaaS company, the honest starting advice is almost boring compared to the billion-dollar exit at the end of this video. Find one specific problem you already understand. Solve it by hand for a handful of strangers willing to pay you before you build anything, and only then start writing the software that replaces your own labor. Everything else in this video, the metrics, the pricing tiers, the growth playbooks, the acquisition at the end, is just what happens next if that first, unglamorous step actually works. If you enjoyed deep dives into the economics behind real industries, don't forget to like the video, subscribe, and turn on notifications for more business documentaries every week.